In this video, I'm going to talk a little bit about the taxation of disability income insurance. Basically, the guiding kind of concept here is that it depends a little bit on who's paying for it in terms of what's going to happen with the payouts, whether they're tax-free or not. So if the policy is purchased by the insured using after-tax money, then the payouts that are received when disability occurs are tax-free. And um, basically, the idea there is you pay taxes on your income when you had income, and you received a benefit when you no longer have an income. And so the government's not gonna tax that because the whole point of that was to protect you in the event that something bad happened. In effect, this is actually relatively similar to the idea of life insurance. You're paying for your life insurance with after-tax dollars typically, and when the payout occurs, it occurs tax-free because something disability scenario, something unfavorable has occurred clearly. And so this insurance was designed to help to keep you from being destitute, that sort of thing. So it doesn't make sense from a policy standpoint to tax it in that case. Now, on the other hand, if the premiums were paid with pre-tax money, then the government looks at that and says, well, you didn't pay taxes on the money you used to buy the policy, so therefore you should pay taxes on the money you received, the benefits you received. So that's a little bit different. Now, that leads to a situation of, well, in that case, if the premiums are paid by the employer, then in that case, again, then the benefits are going to be taxable because the employee did not actually pay the cost for that at all. So these are now going to be taxable. And if there is a company owner that is buying a disability policy, then various kind of rules apply for that depending upon the circumstance. Because that gets a little bit more interesting in terms of whether the company's paying taxes and at what point is it a benefit to the employee. The employee is actually the owner who owns the company. And so kind of the individual taxes and company taxes are a little bit involved. And so various rules apply for those kind of situations. But as a general kind of overarching principle, if the insured person used after-tax money to pay for the policy, then the payouts are tax-free. If somebody else paid for it, or the premiums were paid for using pre-tax money, then taxes are typically going to be owed. That's the general principle that's involved. Hopefully this has been helpful. Thank you for watching and have a great day.